welcome to TheoTrade. This is Don Kaufman. October 5th, 2020. We are seconds after the cash close here on Monday afternoon. A little bit of volatility chop to the upside, but on incredibly low volume. I'm going to break down some of the trade from this Monday. But before we do that, I want to detail a little bit about the SPX, because the SPX, this is kind of where it's at. I mean, for those of you that do tune in on a kind of day-to-day, week-to-week basis, of course, I talk incessantly about expected move. Now, for this trading week that we are in, right, the expected move is about, plus or minus 90 SPX points. Now, time out for a second. For those of you that are brand new, if you don't know what the expected move happens to be, the expected move is really a range that is derived specifically from the options chain. So we can look at options on a Friday afternoon and we can already derive what the marketplace is expecting, the marketplace being the options marketplace, what's expecting by Friday expiration. In this particular case, we're looking for a $90 move up or a $90 move down. Now, if you were to look at that, kind of week over week, and you'll actually see, look at this, like last week at just holding the line up there, the week prior holding the downside of that expected move, and the expected move just carries a tremendous amount of weight. But the point that I want to make on this Monday is, first and foremost, I'm calling this like volatility chop. I mean, just back away for a second from the screen and don't worry about any drawings over here. We have a down day. We have an up day. We have an up day. We have an up day. We have a down day. We have an up day. I mean, it's just, again, what I kind of call volatility slop and chop. But the one big takeaway from today's trading session is, I mean, come on, the SPX finished up 60 points. You're 2/3 of the way home already to the upside here. I mean, we're only looking for a 90-point move. By the way, because you're looking for a 90-point move higher or a 90-point move lower, does it mean that we can't exceed that? No, absolutely not. I mean, if we ended up here at 3460, but at 3460, if we get there by, like, for instance, Wednesday, think about like the risk reward for the remainder of the week. There's still upside potential, but there could be magnificent downside. And that's one of the things that I would look at for a trade opportunity. And some of you that are a little bit newer, when I start talking about that, like, listen, everybody focuses on directional bias. I'll give you directional bias. The marketplace gets up to 3460. It is obviously as hot as can be to the upside. But at the same time, you look at that staggering of a move. And I'm saying, like, right now, down here, this central line, we'll call that like 3350. We blow all the way up to like, 3460. That is a huge move. I mean, you're looking at a 110-point move. You're outside the expected move. And at that point, time out. Think about, again, for the remainder of just this week, the upside potential versus the possibility of downside. And that is probably not equal, because what you're really looking at over here is a standard deviation. And if you move up, for example, 110 points, you're already outside of a one standard deviation move. You're starting to close in on, even like two standard deviation kind of move. And that can just provide really viable setups. And that's something that I will, of course, cover while live in the chat room here at TheoTrade. But I wanted to cover that, first and foremost, because, a lot of these Mondays we've seen just blistering moves to the upside. The previous Monday, obviously the week prior, we touched to the downside. Week prior to that, again, we've had a lot of weeks. First of all, there are a lot of weeks that have hit the edge of the expected move. Let's not discount that as a trade. And that is, we hit the upper edge of the expected move, we pull back. We hit the upper edge of the expected move and just finish the week there. We hit the upper edge of the expected move again, or lower edge of the expected move week in and week out. You can have a high probability of hitting the upper end or lower edge of that expected move. And that's really where I wanted to start tonight's video, because that's a trade that, you might want to look for later in the week, again, from a pure risk reward kind of standpoint. All right, so back to the topic at hand, as I kind of called this, day, volatility chop. And some people look at this like, really? You have a 1.65% move to the upside? Yeah, and it's just chop. I don't think you want to read into this day at all. I mean, if this was a down day, of course, you'd be like, oh, victory is mine, right? But one of the reasons I can't read too deeply into a day like this is just take a look at the volume, right? You realize this is like the lowest volume day that we've had since what? I got to come back here until like, summer times. It's ugly. I mean, the volume out there was just non-existent. So I feel, vindicated in calling it like volatility slop over here. You got to have some volume, some oomph behind a marketplace to really substantiate any moves. Otherwise, we're just, dragging a little higher, dragging a little lower. Now, there are some things that are real standouts. Number one, if you take a look at the Russell really did rock to the upside, but it too, okay, I don't want to overstate this. It was on rather low volume. But if we take a look at the IWM, we actually go over here to apply auto expected moves. Take a look at this. The IWM is pretty much right up against the edge of the expected move. And the IWM, okay, the last couple of weeks, this is worth noting. Outside the expected move, way outside the expected move. This week is going to be no different. The IWM is Mr. Toad's wild ride of movement outside what the options market was anticipating. So one of the cool things you can say inside of the IWM is a great place to deploy things like back spreads, anything looking for outlier type trades. And again, that's something we cover a huge amount here at TheoTrade. So if you're looking for that kind of like, volatility back spreads and so forth, and the volatility, okay, strictly my opinion, the volatility in the options here, this ain't crazy. Like a 30 volatility inside of the IWM, and it's cracking through expected moves. If you bring up the Nasdaq, the Nasdaq ironically has slightly higher volatility. But if you start to look at the Nasdaq and apply auto expected moves to it, it is actually staying inside, generally speaking, inside. Okay, so what you ultimately have is the options market truly getting it wrong inside of the IWM. All right, moving onward and upward. The other real standout. So you had low volume. You slop some volatility on there to the upside. The Russell breaks out. Okay, volatility. I mean, volatility is kind of the talk of the town right now. And yeah, the volatility futures are down, but the VIX, it looks like the VIX went down. It didn't. The VIX actually finished the day ever so slightly higher. Oh, there's a big question mark behind that. Volatility just refuses to back off. So it doesn't matter, again, that you're looking at the S&Ps up 55 one day, down 55 the next. Volatility refuses to back off, which actually brings me to even the VVIX, which is the volatility of the volatility index. Okay, I'm not the only one looking at this because the VVIX is actually slightly bid up as well, which is indicative of traders just ever so slightly came in and bought volatility in the VIX itself. But I don't want to read too deeply into this. And again, if you look at today's option statistics, all right, before you read deeply into anything, make sure there's some size behind it. Today, I actually was kind of pleasantly surprised to find that the volume in the VIX options itself is actually tracking normal, which is interesting given the fact that the volume inside of the S&Ps, the S&P futures, is actually incredibly light, but the volume inside of the VIX options is normal. So that also, of course, brought me over to the SPX. And again, I have tendency to kind of glance around at products like this because I wanted to see, are option contracts moving, all right, in the midst of what's light volume and light hedging activity. And when you start looking at the SPX, it's actually trading above normal volume on the option side of things as well. So you can substantiate the volatility really did go up. This was not like a low volume trade. That's the point that I wanted to make over here. So you're in this like low volume slop fest in the S&P futures, but there was some real trade inside of the VIX, some real trade inside of the SPX to substantiate the purchase of volatility, which you think, the market's going up. Typically when the market's going up, volatility is going down, but that ship has sailed, people. I mean, you're in a very new, very strange little paradigm where volatility refuses to back off. And everybody's like, well, the election is coming. The election is coming. You know what? I've heard the sky is falling. The sky is falling. But the election isn't being drastically priced into the SPX itself. Again, all we're doing is marking time. Volatility is rising up a little bit. Last but not least, on this evening's video, discussion of the bonds. You do realize the bonds, they made a move today. This is a big one. The bonds are breaking to the downside. Okay, now, the bonds breaking to the downside, too early actually to tell. This, okay, absolutely did have and perpetuated some volume. So with the bonds breaking to the downside, that's actually going to take interest rates a little bit higher. Is that a sign of a recovery to, the economy? I wouldn't believe so. I believe what we're actually doing over here, okay, is that traders are actually getting ahead a little bit possibly of inflation, some sell-side activity in the bonds, possibly putting a little bit of capital to work. We have to see how far this is going to go. And again, this, I said this on this weekend's video. There's a lot more questions here than answers. And you have to realize this could be the beginning of a very, very drastic move, to the downside inside of bonds. But I've also contemplated for quite some time that we could see sell-side activity in the bonds and additionally see sell-side activity in the S&Ps. So that's something that, again, we're going to watch this thing play out, but do not necessarily think that sell-side activity inside of the bond market is what we term the reflation trade. This doesn't necessarily mean it's a good sign for the S&Ps. It's a little bit too early to tell. And, with that, the dollar also traded a little bit to the downside, which is kind of what you would expect with an up day inside of the marketplace. But we're going to be watching in just, the next 24 to 48 hours, both dollar and bond trades very, very carefully, because at this point in time, we're kind of on pins and needles. So again, today, a little bit more chop, a little bit more volatility, obviously packing into the marketplace. Maybe today left something to be desired. Don't worry. This is going to be a long trading week. So sit back, enjoy some of the volatility. Hey, at least we're getting two-sided trade right now. That means we go up and we go down. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.